Hello, this is Silvia Pavoni, investment editor of the bank, and I'm talking to Antonio Alves, Senior Regional Head of Trade Finance for Latin America and Caribbean of the International Finance Corporation. Antonio, this is the third day at the IADB meeting, annual meeting here in Calgary, and we were just discussing the unrest and the troubles that have and are developing in the Middle East. And a few people I've spoken to already were mentioning that some are wondering whether this could affect in any way Latin America, and so this brings political risk into the equation in a stronger way. And I was wondering, because of course you have a really broad view of trade finance and trade financing deals happening in the region, what are your views on how political risk is being incorporated in pricing of trade financing deals, and if there are any potential areas of worry across the region?
Absolutely. There is, I think, now bigger concern about political risk than we had before the political unrest in the Middle East. Today, when a banker or a big player wants to engage with a small economy in Latin America, they are analyzing and pricing the transactions on a way that protect them against any political potential problem. As an example, in Latin America, we had political crisis in Honduras in 2009 and 2010, where a lot of banks that were working in the country, they pull out the lines. Fortunately, IFC was already there, and we could provide risk mitigation to those players so they could keep working with that country. Now, with the unrest in Egypt, Bahrain, Syria, the banks are talking to us, to IFC, in order to understand the small economies in Latin America. What is the situation in Ecuador? What is the situation in Bolivia, Venezuela, Paraguay? Am I protected to any potential political problem? And if not, what are the insurance or risk mitigation that I can have in order to better engage or safely engage with that country? So IFC has some instruments that can help the banks on that sense. We have a political insurance company. The name is MIGA, M-I-G-A, and we also have the Global Trade Finance Program of IFC, where we can provide credit risk mitigation and political risk mitigation for any country in Latin America. And because of that, the banks are approaching us more, not only to understand the political risk, but also to use our guarantees to do more with those countries.
And I'm sure that since one of the main topics around the world in the world of banking, and here also at the IADB, is international regulation and Basel III, I would imagine that also international banks are approaching you to see how your services can help them reach the right level of capital to execute transactions in Latin America. Is this correct? And how things are changing with the sale, the idea of Basel III behind us?
Yes, that's the hot topic of the last months. Banks are more concerned and analyzing how they will keep their existing business in emerging markets given the Basel II and now Basel III implementation. We have some real examples of European banks that are already under Basel II, and at the beginning of the implementation of Basel II, they kind of reduced their activities, I guess, because they were analyzing the implications of Basel II. But now, once they have implemented, because of the higher capital allocation that they need to have in order to work with emerging markets, they are using more IFC. So just to give you an example, in the list of our ranking of banks that use IFC guarantee to work with emerging market, top 3 banks are, the top 3 users are European banks. We are looking at the American banks that are still under Basel I. They will go directly to Basel III, and they will probably follow the same pattern as the European banks, meaning they will either need to increase their pricing, the trade finance pricing, because they will need to have to use more capital to work with emerging markets, or they will need to reduce the size of the credit lines. The third alternative to keep working at the same level that they are working today would be to use an effective risk mitigation, which IFC is offering today, AAA credit risk guarantee, where the capital allocation for that risk is very low, and therefore they can keep the existing business.
But it is not only European banks that are coming to you, of course, and you mentioned earlier that you've seen a growing number of Asian delegations at the IADB this year. So I would imagine that Asian banks are also next in line in terms of relationship with you guys and asking for backing.
Yes, we have been seeing a very good increase in the South-South trade flow between emerging markets, between emerging countries. For example, U.S. used to be the main trade partner of Brazil. Nowadays, China is the main partner. So the flows between 2 emerging countries is really increasing. And as a result, the banks located in those countries are now trying to connect with each other, to establish a direct relationship with each other. And because we have a big trade flow from Latin America to China or to Asia and vice versa, we have been approached by Chinese banks, banks in Singapore, even banks in Middle East, to use the IFC risk mitigation in order to get to know different countries and different banks in Latin America. Recently, we have done a big transaction with China Construction Bank. Bank of China has been quite active with us. And we have been talking with other banks in Malaysia also, for example. So, indeed, IFC is playing a role to connect these 2 different regions in order to avoid an intermediary. So that's what we have been seeing lately.
Thank you very much for your comments.
Thank you.